Hello, everyone. Welcome to the final bar. Today, we're going to talk about the S&P pushing to the upside. Now, what's interesting is today, Tuesday, after a long holiday weekend, we rally through the course of the day, but we gapped down at the open. So we ended up right about where we were last Friday on the S&P 500. But the real strength in the FANG sectors, communication services, consumer discretionary, both up over 2%. The NASDAQ by far outperforming the S&P. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts. We have a series of technical analysis tools and analytics and capabilities to help you better understand the world around you as an investor. We are in challenging times. We are in uncertain times, and really some interesting data points that we're getting from the market. On one side, we have these consistent headwinds to growth and headwinds to growth of asset prices and growth of the growth sector in particular, right? In general, all these headwinds, inflationary pressures, the changing of a very accommodative Fed to more of a hawkish Fed, and all the other implications that relates to higher interest rates and so forth. But on a day like today, you see growth starting to kind of work, and you're seeing some individual stock charts improving. And I think that's one of the more important things to be looking for in this sort of environment. We'll get to all of those charts and more here through the course of the show. I did want to let you know about the upcoming schedule. This week, a little bit of a crazy week. We had the Monday holiday off. Tomorrow, I'm on a travel day, so we're going to run a recent episode called Trend Following 101, which is a really cool episode that explains the essence of trend following, how to use stock charts to quantify the trend in the market on different timeframes. Coming up next week, two really good guests lined up for you already. On the 13th, we have Sam Burns from Mill Street Research in Boston. On the 14th, we have Carolyn Borodin, the Fibonacci Queen, joining us once again. Let's continue on today's show and talk about our market recap. Let's focus on what evidence we've gathered today and what that means about the big picture. So an interesting day today with the Dow lower, the NASDAQ higher in a big way, right? The NASDAQ up 1.8% for the NASDAQ composite, the S&P 500 essentially unchanged. Now, the trajectory of the S&P over the last couple trading sessions kind of interesting. Friday and today's sessions actually looked very, very similar, sort of a lower open, but rallying through the course of the trading day. Pretty much a similar pattern to what we saw today. So opening week and trading stronger. Now, the key themes to pay attention to are weaker energy prices, with oil prices down 8-9%, depending on what you're looking at, and the strength in the FANG sectors, right? Bonds bond prices, rallying, interest rates coming off, which is a much better environment for growth stocks. As a result, you have communication services, consumer names, both up pretty significantly. The VIX actually higher, ending the day around 2750. As I mentioned, interest rates coming off today, so the 10-year yield is around 281. The dollar index continuing to push higher. So you have the dollar index up 1.4% using the UUP. Gold, flip that chart over essentially, and that's what you're seeing with gold prices. Gold down 2%, silver 3%, pretty much all the major commodities that we track, particularly in the energy portion, down significantly, with oil and gas down 8 and 9%. The energy sector by far the worst, and a lot of those energy stocks that had been testing key support levels have now broken those key support levels. We'll look at those a little later in a segment, shifting stocks. We'll break down some of the individual names. We have a lot to cover in that segment, and I'll get through as many as I can. Cryptocurrencies continue to be an incredibly volatile space, a very choppy chart in most of these. We pay particularly attention to Bitcoin, which is up about 0.75%, Ether, which is down 0.2%. Now, Bitcoin's rallied pretty good here as we're recording the show, getting back above 20,000. Let's go there first. So when you're looking at some of these cryptocurrencies, I always remind people of the importance of these big round numbers. And if you look what's happened when we reached 50,000, 40,000, 30,000, 20,000 during this downtrend from an all-time high just below 70,000 less than a year ago. Talk about a deterioration in value from 70,000 to 20,000. That's where we've come from. Look at how these big round numbers, it's all been about a big step down and then a consolidation of about 4 to 6 weeks. We're sort of getting toward the latter half, second, end of that sort of consolidation period. If you look at the May consolidation, if you look back to what we did in December of last year, it was about a 4 to 6 week period before we rotated lower. We spent a little more time around the 40,000 level here in the first quarter. It took a couple months actually to eventually break down there. But the point is we sell off and then we consolidate. We sell off, we consolidate. And this is the latest of many consolidations that we've seen. My concern on the chart of Bitcoin is we break down even further, and 17,500 would be the low from last month. We break that. I think that clears the way to going severely lower, significantly lower. Something like 10,000 would be a reasonable downside target given that sort of move. But it's a big if, assuming that we do make that breakdown. And today, rallying back and really just chopping above and below that 20,000 level. So on a chart like this, I'm often asked, what do you do with it? And my answer is it depends on your time frame. If your runway is long enough and you're buying into the long-term prospects of something like Bitcoin, arguably you're getting something that has been, has value much higher than that potentially, and you're getting it at a pretty low value. Something like the emerging growth stocks, some of the emerging tech names, some of the ARK Innovation Fund names that are down so much. An opportunity to get into promising younger companies with the opportunity to rally significantly from here is pretty attractive. However, from a purely technical perspective, I have to respect the trend. And the trend on Bitcoin in a consolidation is still down. And I would say that's the same thing I would argue about the ARK Innovation Fund. Is there a potential for ARK to go and retest the 200-day over the next couple of months? Absolutely. But for me to feel confident about that as an upside target, we would first need to rotate out of this consolidation phase. What this chart of ARK tells you is that you've broken down, we've made new lows, and then when we attempt to make new swing highs, we failed to do so. And that's really what the last year and a half, almost 2 years, has sort of have been like for the ARK Innovation Fund. We're right at that potential turning point where once again, we've made new lows. We're now testing previous resistance. And the question is, do we get to a new swing high? It really hasn't happened at all for the ARK Innovation Fund since back in 2020. If it does happen, that's when you'll hear me start to be a little more encouraging. When we get to the segment in a bit on shifting stocks, we'll dig into that a little more if we have time, going through some of the individual names that might be in a fund like that. The chart of the S&P, again, the last couple of days closing near the highs of the day, that is encouraging. The fact that we're still not too far off of 52-week lows is why I'm not over the moon about the action that we've seen. The momentum is still negative, right? The RSI remaining below 50 sort of tells you, I think, most of what you need to know about the overall trend in the market. I like the bounce that we're seeing. I think it's an interesting bounce, but is it sustainable? And that's where the trend, we've not seen enough evidence to convince me that the trend is reversing to the upside. We still have to pay attention to previous swing lows at 3650 on the S&P 500. Previous swing highs now around 3950. We now have this pretty clear range. We'll see which way we break to the upside or the downside. But notice how we are trading right around this 38.2% retracement level, just like Bitcoin sort of zeroing in on 20,000. Stocks are sort of zeroing in on that key support level. We undershot it, overshot it. Now we're sort of settling in right to an essential fair value for the S&P 500. We'll have to see what's next. Just quickly here, we're going to rotate to our next segment on sector rotation. Today's action, you have communication services, consumer discretionary, technology, 1, 2, and 3. All the other 11 S&P, all the other of the 11 S&P sectors were down today, with utilities and energy both down over 3%. So this was sort of the growth over value trade today. Offense over defense is another way you could probably describe this, with utilities, which is one of the more defensive sectors near the bottom of the list. But for one day at least, this is a bit of a rotation back to the growthy side of the market. The question is always, is it sustainable? At what point do you see enough price action that you buy into the new uptrend theory? Our next segment is called Sector Setups. Talked about the big picture, the S&P rallying off the lows, but still not too far off their previous lows. The trend, by any definition I would lay out, still fairly bearish across the board for equities in the U.S. That is. Let's look at the 11 S&P sectors using the relative rotation graph. And again, if it's your first time watching the final bar, welcome. And I would encourage you, when we talk about relative rotation graphs, Julius DeKempner is one of our StockCharts contributors. He designed this visualization years ago, and I've gotten to know Julius very closely and followed his work for years and years. It's fantastic in terms of how it very beautifully illustrates the phenomenon of sector rotation, which is a thing that investors have been talking about for decades. But this actually gives us a good visualization to see the rotation happening. And it's done using his proprietary model that he created to translate relative strength into this momentum visualization. Further to the right means it's outperforming. Further to the left means it's underperforming. It's all based on relative performance. And the vertical line is sort of the second derivative, sort of the rate of change. So higher momentum or stronger positive momentum is above, stronger negative momentum would go lower on the y-axis. So things in general tend to rotate in a clockwise direction. You can see a lot of big vertical yellow lines here on the weekly RRG. What that represents for energy, utilities, consumer staples, materials, and real estate is that while still the strongest grouping of all of these other sectors, these value-oriented sectors, they are all five of those now in the weakening quadrant. So they had all been in the leading quadrant, showing you this is the strength. It's the late cyclical stocks that are working very well, and the defensive areas of the market, they're all rotating down now into the weakening quadrant, telling you that the relative strength has dissipated in a big way. You're seeing it most notably in energy. And when I look at the chart of the XLE or some of the energy names, which we'll get to here in a moment, you're seeing some really strong trends that have now been pretty quickly unwound over the last 4 to 6 weeks, right? It's coming off of new all-time highs on a lot of the pretty much energy, any energy stock you could come up with, most likely coming off of an all-time high earlier this year, but all pulling back in a pretty significant way. Now they're testing support levels and failing to hold them. This is one of the issues we talked about when we saw a potential weakness in energy. Would it be able to hold support? In charts like Diamondback Energy, I think we're seeing the failure of that support, which tells me energy started to rotate away as sort of the main area of opportunity here, and what's taking in the lead. So it could go in a number of different ways. What we're seeing here on the relative rotation graph is that it's rotating some of the growthy areas of the market: technology, communication services, the only two in the improving quadrant. So if I do it purely based on this rotation and showing us what's rotating out of favor and what's rotating into favor, it's saying value is starting to not work so much. Growth is starting to. Now, what's very interesting, though, is healthcare. Talk about an outlier. The XLV, while most other things are sort of heading straight down, the XLV is actually rotating to the upside. You're seeing a lot of interesting charts in pharma, in biotech, in medical services, and so we'll try to highlight some of those as we can. Providers, was the group that I mean. Healthcare providers, some interesting opportunities there. We'll try to look at some of those as well here in our next segment, shifting stocks after the break. Let's look at the 11 S&P sectors now using the candle glance functionality. So the reason why I like this visualization is it takes a bunch of charts and throws them all on the screen at once. I can now compare them visually. While the RRG is a great way of visualizing the rotation, this is a great way to identify outliers and see what looks similar and see what does not look similar. It's a great way to sort of identify relationships or analyze the relationships between different parts of the equity space. So the first thing that strikes me is how energy, which has been in a pretty consistent uptrend, is now breaking down, right? Breaking down through the 50-day moving average while it had been holding it before, breaking down through the previous support level from April while it had been able to hold it earlier in June. The 200-day moving average not far away, and that's where the XLE has found support a number of times since 2020. And so that might be an interesting, certainly an interesting level to pay attention to. I'm also struck today just by the clearly established downtrend in some of these sectors. When I look at the chart of industrials, when I look at the chart of communication services, when I look at the chart of financials, of materials, these are breakdown charts. These are charts in pretty clear downtrends that have not really changed. Now, while you've seen some short-term strength on a day like today in places like tech and communication services, I'm struck by the fact that we're coming off of new 52-week lows and we're still below two downward sloping moving averages. Once that changes, you'll hear me start to get a little more encouraged about those charts, but I'm not seeing enough of a follow through yet. You're seeing one-day rallies or two-day rallies like we're seeing right now with some nice short-term strength, but short-term strength needs to turn into something a little more long-term, a little more sustainable. That's what I don't think we can say with high conviction that that's happened yet with tech or communication services. Healthcare is a really interesting one. And when we look at this chart of healthcare, we see this sort of sideways choppy trend. And if you don't look at the relative strength at the bottom and you just look at the price itself, how good of a chart is this? Not great, right? I mean, is my general way of describing that. I mean, you've made some higher highs, but lows where you keep kind of pulling back to that 124 level. Just most recently, we undercut that level of support. And now we're, attempting to get back to previous highs. But this is not a chart in an uptrend. But here's the thing. Incorporate the relative strength over the last 6 months, and you can see why healthcare is so compelling. Even though the sector itself is kind of stagnant, right? It's the same level it was about a year ago when you look on an absolute basis. That on its own makes it one of the better sectors, right? This is why the relative strength is going up. In this sort of environment, when the market is so unstable, when you're seeing such renewed downtrends, such renewed downward force with the S&P, the NASDAQ, the advanced decline lines making new lows pretty much every month since November, you want to be in areas of the market that are outperforming. And that's where I think healthcare provides some opportunity. Any of these sectors where the relative strength line is improving, any stocks where the relative strength line is improving, those have been the opportunity. Those have been the strength. And in general, strength begets further strength, right? Stick with stocks that are holding up when the market is struggling. We're going to take a quick break here in a bit. We'll come back with our next segment, Shifting Stocks, where we'll dig a little deeper into some of these particular sectors, look for individual names and groups that are on the move. We'll be at a quick break. We'll be back in 1 minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. I tell you, bear markets are fun. Bull markets are boring. Bear markets are way more interesting. It's challenging, but you can learn so much from analyzing market dynamics. So I hope you're able to use the Final Bar as part of your educational journey during this bear market phase. We're here to help you navigate things. Questions are most likely going to come up in this sort of environment. Everyone's a genius in a bull market when everything's going up. When things are starting to get challenging, this is when we tend to get a lot more questions. So please send your questions our way. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air in our next mailbag segment on Friday's show of this week. Also, go to StockChartsTV.com. That is our on-demand platform. There's so much great content and commentary and educational information on our on-demand platform. Special events like the pitch, our stock charts draft for back in April. So many great ways to just nudge your thinking and help you show how experts are approaching this particular market environment. Go to StockChartsTV.com or on your mobile device, just search for StockCharts TV on demand. Let's continue on with today's show. We talked about the big picture, the S&P rallying today, the NASDAQ rallying today, but still not quite enough of a trend reversal for me to feel super confident about saying this is the new bull market phase. On a sector basis, very much seeing a rotation away from the late cyclical leadership, things like energy in materials, and seeing it actually taken up today by growthy areas of the market. Let's finish off today's show by looking at some individual names and themes that are worth paying attention to. I'll start with China. We didn't talk about China in our macro segment, so let me go there briefly. When you look at the chart of the FXI, not bad. And the fact that the FXI is making a clear newer high or a very, very close to a clear higher swing high here, 34, I think is the resistance for the FXI. That's a large cap China ETF. That we track pretty closely. We attempted to break above there about a week and a half ago, still pulled back a little bit, but a break above 34 and holding that, ideally getting above the 200-day moving average as well, completes a real rotation, arguably, from a bear phase to a bull phase, from a distribution phase to an accumulation phase. And that's quite a change, right? Weak China, strong US was the story in 2021. That was an easy one. If there are easy ones, there's just such a clear differentiation of the trend. Now, these markets, by most ETFs that we would track, bottomed out in March. And now all of a sudden you're seeing higher lows and some higher swing highs. And why is that happening? Well, A number of macro reasons we usually don't have time to get into, but it's charts like LI, which is in the auto space. It's one of the electric automakers. You can see this break above 36. Clearly defined resistance from last July, from last December. We finally break above that level last month, retest it from below, rotating higher again. The stock up 6% today. Charts like that showing a rotation above resistance and holding it is key. This chart above 36 is a pretty decent chart. And out of our entire large cap universe, LI is now the #1 ranked stock. This is a great reminder of the value of the scooter rankings. If you're struggling to find things that are working, look at our scooter reports for large caps, mid caps, small caps, even the ETFs, industries, and that'll show you which price trends are the strongest relative to all the others that you could be looking at there. You also have names like Alibaba, right? So, this is looking similar to the FXI. Clearly defined resistance level in March. In June, this is right around the 120 level. We hit it again about a week ago. Now rotating there, the 200-day moving average, that resistance right around 120, which means if we do get a break above 120, I would argue that completes the rotation from distribution to consolidation to accumulation. The RSI, the momentum more in a positive configuration. Pretty decent chart with the potential to go higher. I don't have trend lines drawn on here, but if you drew a trend line from those previous highs, we've either broken that or very, very close to doing so. One of my conversations recently, and I'm sorry I'm jumping around, but this is where my head is at after a long holiday weekend, doing my best to digest everything that's happening and share some good ideas with you. I talked with a couple of my guests about healthcare, but particularly biotech stocks with a nice move today, getting above 120 on the IBB. Think of that previous chart on the FXI on Alibaba. These were names that had established resistance. We're not quite breaking out. Biotech arguably broke above 120. Again, that holds 120, pretty decent chart. Upside to 135 at the least, that would be the high from April, and also the 200-day moving average. So a good short-term potential target there, nice renewed strength. And the RSI getting just above 60 for the first time since last fall. So that's a nice sort of rotation to more of an accumulation phase. I see a lot to like on charts like that, with potential consolidation resolving to the upside. We talked about semiconductors last week and a nice, a bounce higher off of lows, gapped lower today. So the SMH opened down near 190, closed back at 197, which is above Friday's close. So some short-term accumulation. This is a chart I'm less excited about. Think about those Chinese names that had rotated above resistance, the momentum getting to more of a positive configuration. Here, the RSI still remains fairly negative, right? Because we're still making a new low for the year, even though we closed a bit higher, new intraday low soon after the open. So I'm much more interested in trends that are actually reversing, right? So showing signs of accumulation. This is just showing that we're bouncing off of a new low, not really showing enough of an improvement. So I think in semiconductor space, not a lot to be excited about just yet. I think there's still some potential weakness there. Now we have to talk about the energy space because the energy stocks are down big again today. FANG is one that we highlighted last week. I think on Friday or Thursday's show, this is one of our 3 and 3, sort of highlighting a confluence of support. FANG is bouncing up against previous price support from March and April, sort of those previous lows around 115 or so, 120. And then we also had the 200-day moving average right around that same level as well. We bounced off of both of those in mid-June, and then once again had to arrive there. On Friday, we're getting right to that level. Some of them starting to close below support levels today, pretty much all of them following the through there. So that's Diamondback Energy. This is DVN, which is below previous support, but holding on to the 200-day moving average. For now, we have Chevron, which is clearly broken below price support, testing the 200-day moving average. COP closing below its 200-day today for the first time since November of 2020. So the challenge with this space now is not only have they pulled off of new all-time highs, which is reasonable and expected, now you're actually getting a failure to hold support. So pulling off of new all-time highs is fairly reasonable, right? Pulling back to the 50-day is a totally decent way that a stock should react, and arguably, and often does react after making new highs, right? All that upward momentum, you have some people taking profits, you have a pullback, but then investors come in and buy on the dips. What this trend is showing you is that there aren't enough dip buyers left, right? Sort of the buyers' buying power has exhausted, and now there's no one left but sellers. And as a result, we're failing to hold support. We're failing to hold moving averages. At this point, energy doesn't look like a great space from a technical perspective, mainly because of the inability to hold support levels. Stick with areas of the market that are holding support, that are showing a rotation to potential new highs. Now, just to finish off here very briefly, I've argued that this trend works, this market works if you have the FANG stocks participating. It's a lot of consumer names that are working, the big tech names, things like Microsoft, things like Apple up today, but on a nominal basis. This is not a huge all clear type of move. So something like Apple, I would argue, needs to get above 150. Something like Microsoft needs to get above 280. This is taking it up 275, we'll call it. He says get above those previous highs. At this point, we're still making a pattern of lower lows and lower highs on something like Microsoft and Apple. The momentum still very much in the bearish range, remaining below 60 on any of those bounces. So while we're seeing some short-term strength, you're seeing the major averages close higher, and even the NASDAQ especially up pretty good today. We're not seeing enough, I would argue, from some of these big tech names, the Manamana stocks, as I'm now calling them, actually following through to the upside. That's what I would be looking for in this particular environment. Folks, we need to wrap the show. We need to go to the 3 and 3. We like to highlight at the end of every episode 3 charts that tell the story of this market. Here's chart number 1. This is the GLD. I mentioned gold down today. I didn't get a chance to highlight this one in our market recap segment, but I'll share it with you here. Gold's down today. The main reason is because the dollar's higher. So here we're looking at the gold ETF, the GLD here at the top, and then showing the momentum characteristics, highlighting the differences between a bearish momentum range and a bullish momentum range. Look at that bullish momentum characteristics, November of last year through March of this year, really the end of March. Then we have this transition to more of a bearish phase where the RSI doesn't get above 60 when we rally, and it gets to the oversold condition on sell-offs. We're selling off again today after selling off at the end of last week. The RSI is not quite oversold, but very, very nearly so. Here's the trend in the dollar over the last 12 months, just going consistently higher. It's really hard for gold to mount any sort of strength when you have the dollar strengthening so much. So while inflation has been, arguably one of the key themes for 2022, one of the traditional inflation hedges, gold, has not been a great bet because of the strength in the dollar, and that appears to be continuing. Weaker gold, stronger U.S. dollar. Chart number 2 is the chart of the FXI. I'm struck by the strength that we're seeing in the Chinese ETFs, how different this looks than the chart of the S&P, the NASDAQ, a lot of the other developed markets ETFs that I could share with you. You're seeing a lot of individual names in China starting to rally as well. Charts like LI, now the top-ranked scooter-ranked stock in the large cap space, demonstrates, or really I think highlights the strength that you're seeing in some of these areas of the market. As always, as long as my market trend model remains bearish, which it does as of last Friday's close, it tells me to be cautious, to be nibbling opportunistically anytime the charts warrant it, but not to be looking for aggressive new ideas. So I'm interested in the charts that I'm seeing from China. I would love to see on something like FXI, from BABA, from some of the other charts we highlighted, getting above previous resistance and holding those levels would be vital on getting more excited about a chart like this. Finally, SLB, I highlighted some of the energy names that are breaking down. I think this is becoming, energy has been one of the key stories in 2022. It's still one of the key stories, but now not for making new highs, but actually for showing renewed weakness. SLB is maybe the best illustration of the weakness in the space, coming off of an all-time high around 50 on an adjusted basis, retracing about 38.2% of the long-term uptrend over the last 2 years, which is also right around the 200-day moving average. A bounce, and now closing back below it. That clears the way for some of these downside objectives. $26 would take it back to the lows from summer of 2021, also the spring of that year as well. That might be where some of these energy stocks are headed, but then you could see a renewed bit of strength. That's why focusing on the trend is so important. I would encourage you to do that here as always. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close. Thanks for sticking with us during the summer. We're all sort of shuffling around vacations. So for the show, we're taking some days off when we need to make sure we have the crew available. So we will be off tomorrow with live show. We'll be back with you live on Thursday and Friday. All of our previous episodes and some great interviews are at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.